Welcome back, everyone, to the Dips to Rips podcast. I am Charles Moon with the great Howard Greenberg of the Crypto Crew and Prosper Trading Academy. We have a lot to talk about, Howard. We got a ton to discuss. There's a lot of things that happen both with the United States stock markets, the crypto markets. We basically wanted to focus on one topic today, which was kind of that institutional side of what's happening. A lot with crypto. It's not as known with stocks, but we're going to have to discuss that in just a bit. So I guess, we'll start with the crypto side. And I hate to say it, but lately it's a lot more doom and gloom versus, sunshine and roses. But one important dynamic came into play, which was the rebound. The rebound was pretty substantial because rumors are floating, and maybe you could help confirm this, but rumors are floating that Celsius would face massive and total liquidation if Bitcoin hit 16,000 or thereabouts.
I think it's 15.1 right now. 15.1.
Okay, so now 15.1, right?
There. So yeah, a few things going on. We're definitely seeing all of the contagion risks that have, come throughout the crypto ecosystem. We're seeing how levered a lot of these companies are together. How, quite honestly, one of, the biggest, I guess, lies in crypto was quite honestly the total value locked by these DeFi protocols.
Oh, yeah.
What we're learning is, what started off, let's just use easy, simple numbers. If you had $1 million and you worth of Ethereum, you took it over to Lido, you staked it there. It's $1 million on there. In return, you get ST $1 million worth of that. You take that $1 million, you then go over to Anchor Protocol and you use that to borrow a stable coin like USDC or USDT. So now it's 200. That same $1 million is now 2 million locked into two different DeFi protocols. And you borrow with that probably $750,000 in a stable coin. You then take that stable coin, you go over to Anchor Protocol and you are staking that for their 20% return. Now we're up to $2.75 million was total value locked out of that same $1 million. So we're really seeing that this, levered positions. And quite frankly, what's more alarming is that these, what we considered to be these Degen retail investors were Celsius and Voyager and Three Arrows Capital.
Yeah. So let me point something out. For one, Howard's been warning about this leverage issue for freaking months through our conversation, but most notably through this podcast. I want y'all to know that. Number two, what's more shocking to you, Howard? The fact that these guys were in this position of risk exposure with no exit plan, or the fact that they saw this coming and they kind of degen their risk management anyways? What's more shocking to you? Because
let's break it down a little bit, because I think you got to separate the three situations. So you basically had the three heads of the apocalypse here when it came to crypto. You started off with Terra Luna and the demise of UST there. Then you had the second part, which was Celsius and their insolvency or rumors of insolvency, and them basically locking up their entire platform and still haven't reopened it. And then thirdly, you have Three Arrows Capital, one of the three largest venture capital funds in all of crypto.
The biggest degen of them all.
Yeah. Well, no, because Voyager wins my bet for biggest degen of them all.
Really?
Because if you give half of your customers funds, keep in mind, $700 million is what is being estimated was lent in an unsecured loan from Voyager to Three Arrows Capital. That's as degen as you get. That's
we had to ask who's buddy there.
That's the old Jimmy Hoffa and, let's give Vegas a little money so they can build some casinos. That's really degen. So they had an unsecured loan or letter of credit loan for basically the equivalent of about $700 million. Voyager would have completely gone under if FTX did not bail them out, or Alameda. At this point, I forget, one bailed out one thing, one bailed out the other between them and BlockFi. But yeah, BlockFi. And then Three Arrows Capital going back. Yeah, they were the biggest Degens. And not only were they biggest Degens, when they went down, they had no hubris and they continued to lever further and further. You and I think we used the analogy. It's like they went for the double parlay on the Monday Night Football game and maybe even threw in how many yards, Justin Fields was going to throw for into the mix. So, they were, lots of talk and rumors that even leading right up to their demise, they were first shilling companies and it looks like Voyager was one that took the bait on, let us manage your entire treasury and we'll give you a guaranteed 8% return on that. Give us full custodial control over, all of your sort of treasury funds and we'll manage them. And then the second one is they were trying to sell a product based on the GBTC premium. I've been talking a little bit about that in our coaches chats about how the GBTC, Grayscale is Bitcoin Trust, for all of the bull market ran at a premium over the spot price. And now it's at about a negative 34% premium. And it really got exasperated because the largest holder of GBTC was Three Arrows Capital. They were the largest shareholder with over $500 million in that.
Hold on. Can I circle back to something too with Celsius?
Sure.
So the big issue, and I can't recall if this happened after, I'm almost positive it happened after our last podcast, but they basically emailed their entire client base and says, you can't touch your money, you can't swap, you can't do anything. And it turns out the reason why they had it locked up is because they were basically taking every last dollar they had to mitigate their pricing in terms of margin requirements to a lower level. It turns out it was around 21,000, and then it came down to like 18, 17,000. Last I had saw it was at like 16,000. You just said it was at 15.1, right?
Yeah.
Right.
Yeah. So basically, taking a step back.
Hold on, Howard. So what does that say to you? Because for me, I would say I'm not an expert at crypto. Do I dabble? Do I believe in it? Yes, but I would never put myself in the same ranking as you within the crypto world. But in the same sense, from my visual standpoint, right? The way that I see it from a optical standpoint, this is crazy. This is bad. Guano, if you guys know where guano's from, Pet Ventura 2, but that's like bat guano crazy. So you being an insider, you being, a lifer in respect to crypto, how do you view and feel about that situation when you hear someone like Celsius? And maybe you could provide a better example of what Celsius would be equated to in the stock world. But how do you feel about an institution like Celsius pulling a move like this, obviously to abstain solvency, right? To getting fully liquidated and trying to keep the doors open, so to speak. It's like their last stand.
So a couple of things, I did bring up on this podcast earlier, we had warned about Celsius back with the demise of Luna, as it came to light very quickly that they had been just in front of the liquidations and got $500,000 off of Anchor the day before the peg broke. At that point, I started warning people that Celsius did not sound like they were following through with what they said they were on their website.
You warned me.
Celsius is definitely, in my opinion, was malicious. They advertised as if they were acting as a bank normally would, and in a banking situation, lending out monies that you stored on their platform for a return, and then they shared that return with you, which was your APY. Right. And their APY rates weren't crazy. Their Bitcoin was like 3.5%. Their Ethereum was in that 4 to 5 range. It wasn't like they had 20% on on Bitcoin and 20% on Ethereum. They were more in line with what you sort of expected. But the thoughts and when you looked at it, they talked about it being, very similar to a money market or a CD account that they led you to believe they were making safe decisions. But in the background, as you said, they were making some really, really, degenerate, risky yield farming decisions, playing in the where we thought, like I said, where I really thought all of that volume was being done by these sort of GameStop, Wall Street bet, yield farmers, sort of Degens, like we call it. It was really being done by some of the biggest players in the space. I mean, they were a huge amount of the liquidity on some of these different platforms, which caused the problem. And like you said, what happened is they got themselves to a point, Celsius, where they just had no liquidity left. So to pay down their balance, their margin call, they had to lock all of their users' funds up and use those funds. And they basically, what they did is they emptied out all their users' funds out of their accounts, they used them to pay off their marker on Maker DAO. They've got I think it's a $500 million in that range, right around $500 million loan out. And part of it is, these other coins that they have are locked into protocols with lockup terms. So they're not fully liquid. And the other part was Celsius is really in trouble, where we're seeing the depegging from Lido of staked ETH. ST ETH, which is the liquid staking version of Ethereum.
Right.
It's supposed to be one staked ETH is equivalent to whatever the price of Ethereum is. Because what is going to happen, what you did is if you put an Ethereum on Lido to get that staked ETH, the bottom line is you can't pull out your Ethereum until after the merge is complete and they unlock that from the beacon chain, which is, still probably close to a year away to that unlocking. So while, at some point you will be able to take one ST ETH and in return get one Ethereum, there's no Ethereum for them to give you right now.
Right.
Because it is locked. They don't have the capability to pull it off of the contract. So, and that's where Celsius, and that's what happened with Celsius, is they were taking everybody's money, putting it into the staked ETH as step one to get the money out of Lido, and then using it within the other, parts of DeFi. And the bottom line is that they had to sell the staked ETH for, anywhere from a 6 to almost a 10% loss. It was, pegged down that much.
So like in this situation, it actually sounds extremely familiar with the way you broke it down. So let's break it down from the stock side. Celsius on the stock side became Melvin Capital. For those that don't know who Melvin Capital is, they were the primary firm that was affected from the GME MOAS, or mother of all short squeezes. And listen, for all you AMC apes that want to dispute me on that, when has AMC gotten above $100 since this explosion? And GME ran from $2 to $400. I'm sorry that event has already occurred. I'm sorry that AMC does not have the profile. GME is the MOASS. Now, in that situation, Melvin Capital, pretty similar thing. Money locked up. They actually had to get bailed out, right? Stephen Cohen at 0.72, Ken Griffin at Citadel funneled a little bit more cash for them, enough to keep the doors open so that they could liquidate and just eat their loss. But they were on that flip side. And, we talk about leveraging and almost a semi-degenerate risk management approach. Now, respectfully, GME caught a lot of people off guard. Nobody expected it when it ran from, what was it, 8 to 48, came back to 20s, ripped it up to 100 plus. A couple of days later, it's at 400 and some dollars, and then it comes roaring down, then it races back up. That, all of this was happening in an extremely short period of time. And what this actually did was put the entire financial market at risk. This exposed the brokers in a sense as well. It showed that no matter what the situation is, there's always going to be some sort of vulnerability in the financial markets. And people don't want to say that. Brokers don't want to say that. Institutions don't want to say that. Why? Because the stock market is supposed to be the safe haven. But, the truth of the matter is that we were pretty much right on the edge. If you're wondering why there were restrictions, is because it could have been the end all be all for the stock markets. There could have been an incredible butterfly effect that could have taken place that would have basically killed the market as we know it.
Can I just add one thing to that, Charlie? Yeah,
Sure.
I think what a lot of people don't understand and what happened with Melvin is, as you're saying, and where it is they were over levered with a bunch of different, with Goldman Sachs, they were borrowing from every different person and nobody was communicating with each other. So that's also where the similarities really go to Three Arrow Capital, right? Because what I read on Melvin was, they would walk into Deutsche Bank and say, hey, I need another, $300 million. And, they'd say, okay. And where they're supposed to ask them what they're using it for and make sure that all this wasn't just continuing to be levered and levered and levered. They didn't. And that's what led to Melvin's big downfall too, right? Is that, again, you're given more money than you should be given. Again, that seems to be the underlying aspect. And it even goes back again to 2008, right? This is your Bear Stearns moment, your Lehman moment for crypto. Without a doubt, you're seeing some of the biggest players in the space at risk of liquidation and complete failure of the system because of greediness, because of hidden levered the way there was, they were packaging those junk, they were making junk bonds out of mortgages.
Yeah, but hold on. See, Howard, you broke it down perfectly. Like earlier, you talked about how Three Arrow Capital, right? Three Arrows Capital got an unsecured loan, $700 million thereabouts, you said?
Yep.
Straight from Voyager. And like what you were saying, right? Gabe Plotkin was able to make a phone call, no problem. Makes another phone call, no problem. Another gentleman that recently faced this was a guy named Bill Hwang, right? One of the Tiger Cubs. Same thing. He had a swaps deal with Credit Suisse, swaps deal with Goldman Sachs, Morgan Stanley, Deutsche Bank. And I mean, this guy was levered. Think about the exposure. It took him 2 days to get liquidated and margin instantly. There was no hesitation by these firms to liquidate them. And so just like how you were saying, how could these unsecured deals happen? They happen all the time. They happen in your industry. They happen in our industry. It's just sometimes the reputation is the, how do I say it? The security that these firms are going after. Because
absolutely. And keep in mind, Voyager is a public company, publicly registered company, a publicly traded company in Canada. So this isn't, a fly by night. This is actually traded on the Toronto Stock Exchange.
Right. And well, Gabe Plotkin is also known as a hedge fund manager that's top tier, that he would actually outperform his tiers alongside the markets. Bill Hwang, I believe, took 20 million, turned it into $4 or $5 billion through his friends and family fund, which is what Cohen runs. And, 0.72 and everything else is under Cohen. I mean, they got billions and billions of dollars out there levered as well. Again, not only to Gabe Plotkin to initially start, but to also continue to back him. And, that kind of tells us where the financial system is and has always been, but the exposure is because of now so many more retail participants. Without a doubt, there's a lot more people playing in crypto now versus 2008. There's without a doubt way more retail traders in the stock market now than we had in 2019. So seeing the current environment and the situation, do you see hope for both the stock markets and the crypto markets going forward? And if you see hope, what is giving you that glimmer of hope? Why should people who are naysayers for both, right? For a lot of people, they look at what I do as extremely risky. They look at what you do as extremely risky. They think that the stock market and the crypto market is just a big online casino, and at times it can be. But what would you say to those people now facing the current environment and situation?
Yeah, I mean, both. I mean, I'm still very confident in both. Technology, disruption is not going to stop because Celsius failed or Three Arrow Capital failed. In fact, I would point out that again, while FTX and Alameda and Sam Bankman-Fried have done a pretty good job of bailing out some of these folks, to me, as I've also said, it's really not a bailout, except for one of the things that I saw where it is straight a line of credit. Everything else that they've done, they are partnering and they are going to bring it sort of under their umbrella. FTX is looking to become the Amazon, that steps out of Web3 as the winner. Sam Bankman-Fried's made it clear. I was listening to their CEO of their FTX Ventures today on Bloomberg. She made it clear that they have a lot more announcements coming up here in the future, that they were well positioned for this. What we are seeing is that there was a tremendous amount of mismanagement by a lot of different people within the crypto space. I think that, I think there was also a lot of hubris out there, and people, we listen to people like Do Kwon say that I am the god of all stable coins and, all this stuff. And that they, everyone thought they were the smartest people in the room. And sometimes the loudest person in the room is not necessarily the smartest. And that's what we're finding out.
You're right.
But when it comes to, what I would say is Bitcoin watched, what happened to send us to 17,000 on Saturday. You and I really didn't talk much about this. But, it was really one entity. It was, we don't know who that entity is, but I'm going to have to guess it's Three Arrows. That was liquidated. Purposes ETF, the Bitcoin ETF out of Canada, lost $500 million out of the $1 billion in money under management that they had over the weekend in one liquidation. That liquidation.
So can I just say this about my personal feelings about a guy like Sam Bankman-Fried? Listen, the crypto in itself is filled with a tremendous pool of extremely intelligent people, but that doesn't necessarily make them smart with money as well. And, with SBF, I think this is a guy that is smart enough to understand the venture that he's in, and even smarter enough to capitalize on this. Now, it's a bit sneaky. And what I mean by that is not SNEAKY. I mean SNAKY, I guess, sneaky. A little underhanded, but it's also a matter of business. And I'm not a conspiracy theorist. I'm sure you may have heard of these, but there's all these rumors of underhanded deals with people on Wall Street who are also tied directly into his growth. And this is how he could position himself, which is what it seems like to be the most powerful person in all of crypto. And, we've heard about rumors that a lot of these exploits were orchestrated by him and this whole squad. And, it's one thing to find an exploit. It's another thing to have the money to be able to leverage that exploit. And, these are huge money. Yeah, I mean, these are huge money-making opportunities. Some, we talk about that will take a lifetime that could be made in days. And that's where I kind of see that snakiness come into play. I personally don't trust this guy to be the face, to be the leader of crypto, and you may disagree on this, but there's something about him that makes me feel very untrustworthy about his intentions going
He's
forward.
A banker. He's a banker. He came from
he's
the
smart
world
as
of
hell,
investment. Oh yeah, he graduated from Stanford. The guy is brilliant. He is a quant trader. He was a very successful quant trader in the investment banking world. He came over. I don't Yes, I've definitely heard the conspiracy theories. I do think that somebody was able to point people to where all the bodies were buried, so to speak, when it came to where these, how do you attack it? That needed to be someone that really understood very well the infrastructure, the liquidity, all the things that he would understand better than anybody else, considering that FTX and Alameda, what both of them do. So I do think he's involved. It all sort of started, also the downfall of DeFi started with his infamous interview podcast on Bloomberg, where he called DeFi a black box. And people were like, he's way too smart for that, which is where I sort of came off. If you remember, it seemed to me like that made no sense. I was almost of the opinion that, did he fall and hit his head or something? Because this doesn't sound like the guy that has wowed everybody in Senate committee hearings and so forth.
Exactly.
And then, and then we saw recently the Senate Agriculture Committee and the CFTC with their roundtable in regards to, FTX is trying to do direct clearinghouse, and sort of change the way that commodities are cleared in the US. They're looking for a waiver for FTX to be able to do this all instantly and to use their form of margin and liquidations that they have in place for the general market. So where, in crypto, we don't look at the general overall, we don't look at Charlie's credit score. If Charlie wants to take a $1,000 position in a leverage, 10x leverage on Bitcoin, then if it goes down 10%, Charlie's going to lose his leverage. He's going to lose his collateral.
Right.
So it's all done by the individual transaction. And in those meetings, he was the main crypto person there. Who else was there? The folks from CME, the folks from Citadel, the folks from BlackRock.
I was going to say, is there an off chance that he was just having like a private conversation, maybe with a group of guys like this, and just like started rambling?
No. I think it was much more, he made it clear that his.
So you think it's more orchestrated than that? Than someone catching an idea.
Company was looking to partner with legacy financial businesses to work together to bring them into the space, to teach them the space, and to partner with them in the future. His goal for FTX is to be a full service, brokerage house. He wants to compete with the Goldman Sachs of the world. He doesn't want to compete with the Coinbases of the world. Like you said, he has much bigger ambitions when it comes to what he's trying to do. So I do think that, he was probably, if he wasn't part of it, someone that's almost as smart was, because there's just, there was just too many. They knew where all the bodies were. They knew that.
They knew the exact exploits and how to execute it.
Exactly. They knew exactly which one after which one needed to be hit and in which order to maximize the pain.
So this is where we're at, right? Crypto, let's specifically talk about BTC. Came down to 20. That was an important level. Held 20, rebounded back for about 10%, rolled over a bit, broke through 20, got down to the 17s, and it really started looking ugly. And then if you actually pull it back, right, into a tighter, like zoomed in frame, there's that short period where it basically hit a very quick double bottom, and then it started ripping. And then the markets, of course, started performing well, the stock markets as well. So that kind of helped coincide with each other and help lift that upside directional momentum. And now today, it actually started looking shaky, and then it started holding ground again. So, are we at this point? Because I get this question a lot, and I'll definitely, let me start with this. With the stock markets, I get asked, are we near the bottom? Are we at the bottom? And my answer is, if you think about the events that have taken place that have caused this market to go down, we're talking about inflation getting out of control. Now we're talking about that inflation being so out of control, there's fears of recession. We're talking about companies halting hiring practices, and then we talk about layoffs, right? One day there was Compass, there was Redfin, and there was another company, Coinbase, all announcing layoffs for the day. Elon Musk talking about layoffs today and yesterday and pretty much every single day over the last 2 weeks. And, we're hearing about this, right? So it's only fueling the cause of concern. And then, of course, we have energy prices, which is causing inflation. So if we break it down to the core, let's say it's energy, which it really is, right? And commodity pricing specifically for oil, what's the cause and effect of crude being at $100 plus a barrel? Well, it's the war in Ukraine. Is there slowdown in that? No. Until there's slowdown, that means the market is going to be extremely sensitive to the downside, meaning that you should expect support at this moment to be, razor thin, and resistance level to be very strong and consistent. Those are the signs of what a bear market looks like. We're going to have great rebound days. There's going to be signs of double bottom reversals, and everybody's going to start loading up. And then there'll be one crushing moment, and it's just going to break and flush, and it's going to be all over again. The NASDAQ, specifically the Qs, have yet to breach the 200 SMA on their weekly chart in over 10 years. The last time they were under that level, it was because of the financial market crash of 2008. And since then, we've remained above that level. We are very, very close. We are respectfully around 7% away, 6% away, depending on where we're at today by the finish of this close. So if we're going to see a bounce, it's going to be at that level. But I don't know if it's going to be sustainable. Remember, there's a cause and effect, and the cause, right, of what has spun this market to the downside is still in the picture. It hasn't gone away. So that means the effect is still in the picture and hasn't gone away. Don't count your chickens just yet. Now, do you feel, Howard, that when we look at BTC, that we're starting to find a little bit of ground, especially with the price action we've seen, into the upper teens, into that 20 level? Or are you worried that winter is going to get much, much colder and we may see BTC start spiraling even lower?
Well, I mean, I think hopefully we're running through the effects of Three Arrows Capital, the latest of the sort of deleveraging situations. So hopefully that's going to help. I also, my bigger worry right now is miners. We've seen that, we saw that Bitfarm sold 3,000 Bitcoin, but that's only half of their holdings.
Still sold
miners,
half.
Yeah, that's half. So keep that in mind, that you're going to see a lot of pressure coming from the miners. Energy, like you said, has gone up. While a lot of them have cheap energy, that energy still went up. Bitcoin's price going down puts a lot of pressure on them. The interest rates going up. Yeah, well, and then also you also take into the effect that, a lot of these were getting cheap money due to quantitative easing and low interest or free interest rates, right? So they could simply borrow money to pay their bills. Now that money is more expensive. They're looking at, and I think that also shows you that, Bitcoin miners who probably know Bitcoin better than anybody else are looking at a longer crypto winter still in front of us, because otherwise they wouldn't have sold 3,000 Bitcoin. They would have sold, 8,000 Bitcoin.
Yeah. So for people wondering what Howard is saying, just in case you can't, put two and two together here, no disrespect, but what he's saying is that if the miners have to start unloading Bitcoin, that means they're throwing supply into the marketplace, in the marketplace, which would depress the price, right? It would be like a massive sell order coming into the markets, because the miners need to cash out. They need that fiat or whatever they need it as to pay off whatever payments to creditors, like Bitfarm did, BITF. And what Howard's suggestively saying is that if these miners start dumping, that's going to apply more sell side pressure on the markets. Am I correct?
Yeah, absolutely. Okay. That's what you're going to see in the short term still. Across all of them. We haven't heard from Mara. We've heard from most of the other publicly held ones. Argo announced what they sold. Galaxy Digital announced what they sold. We have not heard from Mara yet. I'm not sure when their next quarterly earnings are. But yeah, and basically last month was the first month since 2018 that we saw more miners outflows were larger than the amount of Bitcoin they mined. So not only did they give up everything that they mined, they also, gave from their long-term holdings.
Man, that's tough. So what do you think could be, one of the things that I'm really worried about is that somehow Bitcoin spikes lower and we get, let's say we trade through 15, and that 15 level is that marginable level, right? That auto liquidation for Celsius. So what do you think an event like that in the worst case scenario will turn into? Do you think Bitcoin starts working their way to 10?
That's you start talking about that. I'm not sure if I'm not mistaken, though, that's actually an Ethereum loan, if I'm not mistaken.
So, okay.
It could be wrapped bit.
I saw WBTC, but I'm unsure of that.
Okay. Let me double check here quickly. I don't want.
I mean, like I said, hey, my news source is Twitter. But I mean, again, do you feel like it would be somewhat catastrophic? Like,
yeah, I mean, we saw $500 million just get dumped on Saturday. It took us from 20 to 17. Within 12 hours, we were back at 20. So, we were, we were in this situation already. So,
what makes it difficult?
But what you have is, could you get? Here's what could happen. If we go down to 15, and let's say Celsius or 3 Arrows Capital has no other or this is actually Celsius, excuse me. If Celsius has no other situation to go through, they liquidate. That's going to further liquidate 3 Arrows Capital in their positions, and that still unwinds even further. Could put BlockFi back in risk again. They go even further under. You know what I mean? As you have a contagion, and then you got to start worrying about Michael Saylor. If you get to that point, he claims he can hold to 3,500. Is his stockholders going to let him hold to 3,500?
Exactly. I mean,
that's the part you have to worry about. Do I think we get to any of that? I don't. But I also didn't think we'd be where we are today, to be honest with you.
This guy, Michael Saylor, was taking huge swings in the upper third of where Bitcoin came from on the early rally to where it peaked out at 69. And this guy was swinging extremely hard on a month by month, quarter by quarter basis, basically from 30 and beyond, predominantly because he was getting so much cash thrown at him. So he just had a lot more money to work with. And he has the ability to raise more cash. He has the ability to leverage out loans as well, to kind of prevent that margin as well. But like what you had said, is that money going to be willing to, take that shot at those levels, being that close to, a major margin call? Supposedly he faced one and it was all handled, no problems. It was a bigger event.
Keep in mind that their first, I forget the amount of Bitcoin, but it's like over 1,000 of them that they bought were all paid for in cash. So they had a huge amount of Bitcoin that they can use as collateral.
Right. That's not investor money, and I totally get it. I'm afraid of what the possibilities can be, but I'm actually probably a lot more optimistic than I would have been hearing all the news 2 weeks ago. My feelings is that we're getting to this point where people are now starting to get very hungry at the opportunity because they missed the first run up. And even if they are buying in at 20,000, people will be comfortable because they're already planning, if it goes lower, to cost average in. And that there are a lot of money that was pulled out of crypto near the highs, on the break of 40s, even the break of 30s, that put people in a very strong cash positive position to reload, because just like you are, they're BTC maxes, right? And I also feel that this is where the institutions, they're not getting afraid, they're getting, if anything, more excited. We heard about Citadel now opening up a crypto fund. Shocking, right? Cheap value, great upside opportunity. Now they want to get involved. Howard, you talked about Citibank. You want to talk about that Citibank news that you were talking about earlier with me?
Well, just hearing that cities out there looking to buy distressed, assets here during this drop. They're definitely interested in merger and acquisition. I saw a report today from I think it was Needham, from John Todaro, their senior crypto analyst, and he was going over, what's looking like it's going to be a huge amount of M&A in, the next quarter. As it said, consolidations increasing on the back of the crypto bear market, present a number of M&A opportunities second half of 22 and 23. Expect exchanges and service companies to be the primary acquirers. So look for Coinbase, Kraken, Binance, FTX, Galaxy Digital to be the main, buyers in this situation. That's what we're probably looking at. We're going to see more merger and acquisition in the space. We're going to see, the same way like we've talked about, when .com bubble started, Netscape was the leader, right? Netscape and AOL. No one knew what Petco or Facebook or Amazon were yet. So, we're in that stage, and I think you're going to see a couple of huge winners come out of this. FTX probably being one of them. Binance has a lot of money right now. They're going to buy a lot of stuff. Hold
on. Howard, yes or no? Once U.S. government gives the okay, do you think that Wall Street will be involved in crypto?
Yeah, why would Citadel isn't wasting their money? Yes.
Okay, so Wall Street is known to be the most savviest in terms of money-making hustlers in this world, in any industry that you know. And so if Wall Street is just chomping at the bit to get involved in this industry, it's going to be worth something in the long run, if not forever. Okay, I can't guarantee anything in terms of forever, but I know for a fact that, and I'm just going to be very transparent with you, Howard, I became super excited about crypto once I realized that Wall Street was super excited about crypto. But the banks can't really do anything on their own. They could get into it in certain aspects, like the business aspect. They could use the guise of their high profile clients want to be participants and investors in crypto. But truth be told, if Citibank, if Morgan Stanley, if JP Morgan, if Goldman Sachs, if all of these other, clown school Wall Street bankers had any opportunity, the second they could get in, I promise you there's going to be billions of dollars that are going to be thrown into this industry overnight. And there'll be billions more coming immediately after the following night. And then the following night after that. And we're going to see an immense amount of inflow into this industry in an extremely short period of time. And if you folks aren't going to be involved at that moment when Wall Street decides to get involved, you will be, in my opinion, fairly late to the party. This is why that I am a believer, not just accumulation here, but definitely for the longer term picture, because the major catalyst, whether you agree with me or not, is when Wall Street money gets involved into this industry.
Absolutely.
Once that happens, game changer. Game freaking changer. I don't know.
Without a doubt, I agree.
We'll have to wait and see how that plays out. But this has been a pretty interesting podcast. I wish we could just rail on for the next 3 hours, but we can't. We got to cut it out here soon.
Absolutely.
But, any final thoughts about, let's say, till our next wonderful episode here, sir?
No, man. I mean, just keep your heads about you, understand there's going to be some bargains, like Charlie said. I don't know if we're all the way at the bottom, but we are in the bottom, 5 to 10% less, left maybe to a drop in, if there's no other macro, drop. So, start to get ready to accumulate.
Yeah. I am 100%, 100,000,000% on board with that. Howard, that I tweeted the other day, right? If you want to follow Howard, it's at Howard Green BE16 on Twitter. You can follow me at the Disciple of Trend as well. We'll have our producer put down our quote unquote links at the bottom. But listen, we may not be at the bottom, but we're certainly not going to stay down here, for a decade plus. The market has been extremely resilient. The crypto market has shown time and time again, along with the stock market, that we're going to rebound back and remain strong. Do I suspect that we're going to have a lot more weakness? That is very, very possible. Absolutely true. In all respect, though, this is going to be one of those opportunities, right? When you said 2 years ago, I wish I bought so-and-so. I wish I bought this. I wish I bought that at this price. And here we are. What are you waiting for? That's all I have to say. I mean, just think about it. Just think about it. I can't promise we'll get back to those highs. We may even go higher, but I certainly don't think that we're going to stay down here for years upon years, at least not yet. There's nothing to say that, at least not yet. So, ladies and gentlemen, we're going to wrap this up. I just want to say thank you, Howard, for your insight. Amazing as always, my man. It's always fun to do this with you. Ladies and gentlemen. Good to talk to you, Charlie. Good to talk to you there, buddy. Yeah, make sure you follow us, folks, on our socials. Make sure that if you happen to love this episode, share with your friends, get the word out. Click that like button, click on the notification so you know when we're dropping our next podcast. Ladies and gentlemen, peace and love. See you at the next one.
This has been Dips to Rips with Howard Greenberg and Charlie Moon, brought to you by Prosper Trading Academy. Visit us at prospertrading.com to find out more. This podcast should not be considered professional, financial, and/or investment advice. By accessing this podcast, you acknowledge that Prosper Trading Academy LLC, PTA, makes no warranty, guarantee, or representation as to the accuracy or sufficiency of the information featured in this podcast. The information and opinions presented in this podcast are for general information only, and any reliance on the information provided in this podcast is done at your own risk. PTA does not endorse, approve, recommend, or certify any information, product, process, service, or organization presented or mentioned in this podcast, and information from this podcast should not be referenced in any way to imply such approval or endorsement. The third-party materials or content of any third-party site referenced in this podcast do not necessarily reflect the opinions, standards, or policies of the PTA. PTA assumes no responsibility or liability for the accuracy or completeness of the content contained in third-party materials of the third-party sites referenced in this podcast, or the compliance with applicable laws of such materials and/or links referenced herein. Moreover, PTA makes no warranty that this podcast or server that it makes it available is free of viruses, worms, or other elements of codes that manifest contaminating or destructive properties. PTA expressly disclaims any and all liability or responsibility for any direct, indirect, incidental, special, consequential, or other damages arising out of any individual's use of, reference to, reliance on, or inability to use this podcast or the information presented in this podcast.